Welcome to Capitalists versus Consumers, where we break down how money really works and show you how to start building income that works for you. Today, we are covering one of the most powerful and most misunderstood passive income strategies available to everyday investors: building a dividend income portfolio from scratch. Dividend investing is one of the oldest and most proven wealth-building strategies in history. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble have been paying and growing their dividends for decades, creating streams of passive income for investors who never have to sell a single share. Today, we are going to walk through exactly what dividend investing is, how to build a dividend portfolio from zero, which stocks and funds to consider, and how much income you can realistically expect over time. Quick note before we get into it: everything we cover here at Capitalists versus Consumers is for educational purposes only, and not financial advice. Always do your own research and consult a qualified financial professional before making investment decisions. Please hit the like button and subscribe so you never miss a report. Let's get into it. What is dividend investing? A dividend is a payment that a company makes to its shareholders, typically every quarter, out of its profits. When you own shares of a dividend-paying company, you receive a cash payment for every share you hold, regardless of whether the stock price goes up or down. Think of it like owning a rental property. The property might go up or down in value over time, but every month the tenant pays rent. And that rent is income you receive regardless of what the property is worth on any given day. Dividends work the same way. The stock price fluctuates, but the dividend income keeps coming in consistently. The dividend yield is the annual dividend payment expressed as a percentage of the stock price. If a stock is trading at $100 and pays $4 per share per year in dividends, its dividend yield is 4%. That means for every $1,000 you invest in that stock, you receive $40 per year in dividend income. Why dividend investing is so powerful? There are 3 reasons dividend investing is one of the most powerful long-term wealth-building strategies available. Reason number 1: compounding reinvestment. When you reinvest your dividends, using the cash payments to buy more shares, you trigger one of the most powerful compounding effects in investing. More shares means more dividends. More dividends means more shares. Over decades, this compounding becomes extraordinary. Historical data shows that dividends have accounted for approximately 40% of the total return of the S&P 500 over the long term. That means nearly half of all stock market wealth creation has come not from rising stock prices, but from dividends being paid and reinvested over time. Reason number 2: income that does not require selling. Most passive income strategies eventually require you to sell an asset to access the income. A rental property requires a sale to access equity. A growth stock requires a sale to realize gains. Dividends are different. They pay you income without requiring you to sell anything. Your shares remain intact, appreciating over time, while the dividends generate cash flow independently. This is the foundation of the financial independence concept: owning enough dividend-paying assets that the income they generate covers your living expenses without ever having to sell a single share. Reason number 3: dividend growth beats inflation over time. The best dividend stocks do not just pay a consistent dividend, they grow it every year. A company that raises its dividend by 6 to 8% annually will double its dividend payment in 9 to 12 years. An investor who bought Johnson & Johnson 20 years ago is now receiving dividends that are dramatically larger than what they received at purchase, often exceeding their original investment as annual income. This dividend growth protects investors against inflation in a way that fixed income, like bonds or CDs, cannot. A bond pays the same coupon forever. A growing dividend keeps pace with and often exceeds the rate of inflation over time. The different types of dividend investments. Before building a dividend portfolio, you need to understand the different types of dividend-paying investments available. Individual dividend stocks are shares of specific companies that pay dividends. These give you the highest control over exactly which companies you own, and often the highest yields. But they also require the most research and carry company-specific risk. If one company cuts its dividend or goes bankrupt, it directly impacts your income. Dividend ETFs are exchange-traded funds that hold a basket of dividend-paying stocks. A single ETF might hold 100 or more dividend-paying companies, giving you instant diversification. Dividend ETFs typically have lower yields than individual high-yield stocks, but dramatically lower company-specific risk. They are the easiest starting point for most beginners. REITs, real estate investment trusts, are companies that own and operate real estate and are required by law to distribute at least 90% of their taxable income to shareholders as dividends. REITs offer some of the highest dividend yields available, often between 4 and 8%, and provide real estate exposure without the hassle of owning physical property. They trade on stock exchanges exactly like regular stocks. Dividend-focused mutual funds work similarly to dividend ETFs, but are actively managed by a fund manager who selects dividend-paying stocks according to specific criteria. They typically have higher fees than ETFs, but some investors prefer the active management approach. How to build your dividend portfolio from scratch. Step 1. Decide where to hold your dividend portfolio. The account type matters enormously for dividend investing because dividends are taxable income in the year they are received. In a taxable brokerage account, you pay taxes on dividends every year, reducing the compounding benefit. In a Roth IRA, your dividends grow and compound completely tax-free, and you pay zero taxes on withdrawals in retirement. For most investors building a dividend portfolio for long-term passive income, the Roth IRA is the optimal account because the tax-free compounding dramatically amplifies the power of dividend reinvestment over time. Step 2. Start with dividend ETFs before individual stocks. For beginners, the most accessible and most diversified starting point is a dividend ETF. Here are the strongest options to consider. The Vanguard Dividend Appreciation ETF, ticker symbol VIG, focuses on companies with a history of growing their dividends consistently, not just paying high dividends right now. The current yield is approximately 1.8%, but the dividend growth rate is strong and the quality of the underlying companies is exceptional. VIG is ideal for investors focused on long-term dividend growth rather than immediate high income. The Schwab US Dividend Equity ETF, ticker symbol SCHD, is widely considered one of the best overall dividend ETFs available. It combines a solid current yield of approximately 3.5% with strong dividend growth and excellent quality screening. SCHD filters for companies with at least 10 years of consecutive dividend payments, strong cash flow, and solid fundamentals. It is the starting point many dividend investors recommend above all others. The Vanguard High Dividend Yield ETF, ticker symbol VYM, focuses on stocks with above-average dividend yields. The current yield is approximately 2.8%. VYM holds over 400 stocks, providing broad diversification across high-yielding companies. For REIT exposure, the Vanguard Real Estate ETF, ticker symbol VNQ, provides exposure to dozens of real estate investment trusts in a single fund with a current yield of approximately 3.5 to 4%. Step 3. Learn individual dividend stocks as your portfolio grows. Once you have a foundation of dividend ETFs and understand how dividend investing works, you can begin adding individual dividend-paying stocks for higher yields or more targeted exposure. The most widely respected category of individual dividend stocks is the dividend aristocrats, S&P 500 companies that have increased their dividend every single year for at least 25 consecutive years. These are companies that maintained and grew their dividends through recessions, financial crises, pandemics, and every other challenge the economy has thrown at them over a quarter century. Some of the most well-known dividend aristocrats include Coca-Cola, which has raised its dividend for over 60 consecutive years, Johnson & Johnson with over 60 years of consecutive increases, Procter & Gamble with over 65 years, and Realty Income, a REIT known as the monthly dividend company because it pays dividends every month rather than quarterly. Step 4. Set up dividend reinvestment. Every major brokerage offers automatic dividend reinvestment, called DRIP for Dividend Reinvestment Plan. When you enable DRIP, your dividend payments are automatically used to purchase additional fractional shares of the same stock or ETF, rather than sitting as cash in your account. This is one of the most powerful wealth-building tools available, and it requires zero ongoing effort once set up. Every dividend payment buys more shares. More shares generate more dividends. More dividends buy more shares. The compounding effect over decades is extraordinary. Step 5. Add to your portfolio consistently. Dividend investing rewards patience and consistency above almost everything else. Adding to your positions regularly, monthly or quarterly, through dollar cost averaging allows you to accumulate more shares during market downturns and builds your income-generating base steadily over time. What kind of income can you realistically expect? Let's talk real numbers because this is what most people actually want to know. With a 3.5% average dividend yield, which is achievable with a portfolio focused on SCHD and high-quality REITs, here is what different portfolio sizes generate in annual dividend income. A $10,000 portfolio generates approximately $350 per year, about $29 per month. A $50,000 portfolio generates approximately $1,750 per year, about $146 per month. A $100,000 portfolio generates approximately $3,500 per year, about $292 per month. A $500,000 portfolio generates approximately $17,500 per year, about $1,458 per month. A $1,000 portfolio generates approximately $35,000 per year, about $2,917 per month. These numbers assume no dividend reinvestment and no stock price appreciation, just the raw dividend income. With reinvestment and the natural growth of dividend payments over time, the actual income generated accelerates significantly. The realistic path to meaningful dividend income for most people is a long-term commitment. 5, 10, 20 years of consistent investing and reinvestment. The people who retire on dividend income did not build it quickly. They built it methodically over decades. The risks of dividend investing. No investment strategy is without risk, and dividend investing has specific risks worth understanding. Dividend cuts are the primary risk. Companies can and do cut or eliminate their dividends during financial difficulty. A company that cuts its dividend often sees its stock price fall simultaneously, creating a double hit for dividend investors. The best protection against dividend cuts is focusing on high-quality companies with long histories of maintaining dividends through difficult economic periods, which is why the dividend aristocrats are so highly regarded. Dividend traps are stocks with extremely high yields, sometimes 8, 10, or 12%, that appear attractive but are often signals of financial distress. When a company's stock price falls dramatically, its dividend yield rises, because the yield is calculated as dividend divided by stock price. A very high yield often means the market is anticipating a dividend cut. Always investigate why a yield is exceptionally high before investing. Interest rate sensitivity is a real factor for dividend stocks and REITs in particular. When interest rates rise, dividend stocks sometimes underperform because income-seeking investors can now get competitive yields from safer bonds and CDs. The current elevated rate environment has created some pressure on dividend stocks and REITs, though this also creates potential opportunity as rates eventually normalize. Concentration risk in dividend portfolios is worth watching. Dividend-paying stocks tend to be concentrated in certain sectors: utilities, consumer staples, financials, real estate. A dividend portfolio that is not diversified across sectors can be disproportionately affected by weakness in any one area. The bottom line: dividend investing is one of the most proven, most accessible, and most rewarding long-term wealth-building strategies available to everyday investors. It requires patience. The income builds slowly at first and accelerates dramatically over time with consistent investing and reinvestment. It requires quality, focusing on companies and funds with strong, growing, sustainable dividends rather than chasing the highest yields available. And it requires consistency, adding to your portfolio regularly regardless of what the market is doing in any given month. The goal is simple to understand and challenging to execute. Build a portfolio of dividend-paying assets large enough that the income they generate covers your needs without ever selling a single share. That is financial independence in its purest form. Start small. Start today. And let the compounding do the rest. That is a wrap on today's breakdown here at Capitalists versus Consumers. If this gave you a clear path to building dividend income, please hit the like button. It helps more people find this content. Subscribe and turn on notifications so you never miss our weekly breakdown every Friday after the close and our daily after the bell market report every trading day. We will see you in the next one. Resources mentioned in this video: The Little Book of Dividends by Charles Carlson, Dividend Growth Investing by Nathan Winklepleck, The Ultimate Dividend Playbook by Josh Peters. This video contains affiliate links. I may earn a small commission at no extra cost to you.